Welcome to It Starts with $1, real talk about financial freedom. I'm Krista Cooper, and I'm here with Shanice Boyd. She's the Assistant Consumer Lending Manager. Hi, Shanice. How are you?
I'm great. How are you?
Good. And I've got Sherelle Mullen. She's the Consumer Lending Team Lead. How are you?
I'm doing well, thank you.
Awesome. Well, we're going to get right into it. The topic for this episode is, what are interest rates costing you? This is the credit card edition, and this version zeroes in entirely on credit cards, making clear just how expensive balances have become and how a credit union can meaningfully help members lower the cost. To kick things off, Shanice, your most expensive debt isn't your mortgage. Apparently, it's your credit card, right?
Definitely. So think about your monthly bills for a second. If you're like most people, you probably keep a close eye on your mortgage rate, or maybe you stress about the interest rate on your auto loan. But what if I told you that your most expensive debt isn't your mortgage? It's the plastic sitting right inside your wallet. Right now, Americans are drowning under a record-breaking $1.28 trillion in credit card debt. And with average APRs sitting above 21%, carrying the balance has never been more painful. That is exactly what we're breaking down today. This episode is all about uncovering that hidden math in your wallet, finding out how much those massive interest rates are actually costing you every single month, often silently.
All right, so we got to get into why credit card interest rates are so high right now. And so, Sherelle, this is where you come in. Near record APRs aren't going anywhere. We heard news about rates dipping slightly at the end of last year, but a projected average of 19.4% for 2026 still sounds incredibly high. Why are these near record APRs sticking around?
Well, even with slight declines, 2026 average APRs are still expected to hover around about that 19.4%, just by historical standards. Many consumers are relying more heavily on credit cards to manage cash flow under financial strain. Their balances are growing faster than spending because people aren't paying their balances off monthly.
Yeah, I know. We're all feeling a lot of that. Fed cuts don't help credit cards much. So a lot of people think the Fed is cutting rates, so my credit card bill is going to go down. But why is that then a misconception?
Everyone thinks that. Unlike mortgages, credit cards don't adjust quickly or sometimes at all when the Fed lowers the rates.
And if the Fed influences short-term rates, what are these risk assessments that lenders are using to keep card APRs so high right now?
The Fed influences short-term rates, but card APRs also heavily reflect risk assessments by lenders. It remains elevated just due to economic signals.
Yeah, and then political pressure, right, is rising.
Definitely.
There has been a lot of political buzz about a potential 10% APR cap. So realistically, will consumers save anytime soon?
There's renewed talk about a 10% APR cap, but even with bipartisan interest, it hasn't resulted in a real policy change yet. High interest rates remain largely unchecked, meaning consumers are still paying the price.
All right, so let's transition into what these rates are actually costing you. Shanice, we're back with you. Interest charges that eat your paycheck. Let's break this down. If someone is carrying a pretty standard $5,000 balance at a 21% APR, what does that look like in actual dollars that are thrown away every month?
So a small balance of $5,000, about 21% APR, costs around about $84 a month and about $1,000 per year in the interest alone.
Oh, my goodness. And it's getting harder, not easier, for people to escape that debt. Right?
Yes.
And let's talk about the psychological toll then on a person watching a balance barely budge month after month because interest keeps eating up that payment.
So it can break a consumer's motivation, feeling like a human revolving door. You're running as fast as you can, pouring hard-earned money into your debt every single month, but you're stuck in the exact same place. Psychologically, it creates a unique kind of financial despair. It's exhausting. It feels endless. And it's precisely why people give up on trying to pay off their debt altogether. Nearly 23% of Americans don't believe they'll ever get out of their credit card debt. They don't realize that it's not a personal failure. It's just the brutal math of a 21% APR credit card.
Oh, my goodness. And even future relief looks small. So how does a high APR change how long it takes to pay off a card if a member is only able to make that minimum payment?
High-risk borrowers may see no reduction at all, since lenders price APRs partly on perceived financial strain. At 20% plus APR, a typical card balance can accumulate interest faster than most people can pay it off. Forecasts show only minor rate reductions, fractions of a percent in 2026.
So bottom line, if listeners are carrying a balance, they're paying some of the highest borrowing costs in the entire financial system. And we're going to pivot here to the rewards trap and talk about when does high interest cancel out your cash back, right? Because we all love points, we love miles, and we love the cash back. But how are these rewards programs turning into a financial illusion for people that are carrying a balance in 2026?
So this creates the illusion of a benefit while the actual cost, which is the interest, quietly grows in the background. Balances are growing faster than spending because people are not paying off monthly. That's where rewards quickly go from free money to financial illusion. While rewards can be valuable, it only works in the favor if you pay your balances in full every month.
Yeah, I mean, that's really good to know right off the bat. You know, and we're noticing a lot more people are putting a lot more on their credit card than they were before, right? Just because of where we are, with the economy right now. Break it down for us then. If someone gets 1.5% cash back, but is paying a 21% APR on their balance, who's really winning in this equation?
So not the consumer. If someone earns $300 in rewards in a year but pays $1,000 in interest on a revolving balance, which is very common today with APRs, they're not getting ahead. They're actually losing money.
And then is it true then that your interest charges erase any value from rewards? Like, how does that work?
Yes, you're likely paying more in interest than you're earning back in cash back or points. Rewards become a psychological distraction.
Oh, my goodness. And data shows credit card balances spiked past $1.2 trillion recently as people use cards just to manage daily expenses like we were mentioning. Why is chasing rewards especially dangerous then when you're using credit as a cash flow safety net, which a lot of people are doing right now?
So let's think about it. In that environment, even great reward programs cannot offset the cost of carrying a debt at nearly 20%.
I know. It's scary
Very
because you think, hey, I'll get the points, I'll get the cash back, I'll get the miles, and eventually it catches up to you, and it may not be such a great situation. Well, Sherelle, we're going to you in terms of how a credit union then can help reduce what you're paying by a lot. This is great information to share because, big financial institutions are maximizing profits at high rates, but credit unions operate differently. So how does the not-for-profit credit union model directly benefit someone drowning in card debt?
Credit unions consistently offer lower credit card APRs than banks because they're member-owned, not profit-driven. Even a drop from 21% to 13% saves hundreds or thousands per year.
I like the sounds of that.
Yes.
Right? And if a listener is listening right now and they're stuck at that 21% or 24% APR with a traditional bank card, what kind of relief can they typically find then by switching to a credit union card?
They could slow down that interest they're paying by completing a credit card debt consolidating into a lower rate credit union loan. It can significantly cut monthly interest costs. They can also look into a credit union personal loan, which often have fixed, predictable payments, unlike variable credit card APRs.
And for someone with multiple high interest cards, how can the credit union help them to bundle all of that chaos into one lower cost consolidation loan?
They can help members plan debt payoff, review their spending patterns, look into creating a customized repayment timeline, and improve their credit score health, which ultimately can lower future APR offers.
And I know there's many people listening right now. What is the first step they should take today if they want a credit union expert to look at their debt and help them lower their monthly costs?
Well, first step would be to give us a call here at Dover Federal, or you can stop into one of our local branches.
Absolutely. And this episode has been all about finding out what your credit card is really costing you. As we wrap up today's episode, let's take a quick look back at the critical questions we uncovered today. We started by asking why credit card debt has become the ultimate silent killer of household budgets, ballooning to a record $1.28 trillion nationally. We looked at the literal dollar cost of carrying a balance, and most importantly, we exposed the rewards trap, proving how a tiny 1% to 2% cashback perk is completely wiped out by that 21% interest rate. You don't have to face these numbers alone, though. Dover Federal Credit Union operates as a not-for-profit, meaning they are structurally built to offer lower rate cards, balance transfer options, and consolidation tools to help you keep your hard-earned money.
So I have a challenge for our listeners today. Find out what your credit card is really costing you. Before you look away from your finances, take these 3 immediate steps. Check your current APR. Log into your account. Look at your current statement. Many people have no idea their rate has quietly climbed past 20% or even 24%. Review your monthly interest charge. Look past the minimum payment due. Find a line item that shows exactly how many dollars are being thrown away on interest every single month. Talk to your credit union. Sit down with a financial expert at your credit union. Ask them about freezing at high interest with a low rate balance transfer, bundling your debt into a consolidation loan, or switching to a credit union issue card designed to save you money. Bottom line is you don't have to accept a 20% APR. Not when you have a credit union in your corner. Take control of your balance today. Look at the real numbers and let your credit union help you build a path toward true financial freedom.
Such great information. It starts with $1. Real talk about financial freedom. Thank you, Shanice and Sherelle. For more information and to listen again, you can visit doverfcu.com or wherever you get your podcasts.